Welcome to the Deep Dive, where we cut through the noise to get you well informed on what matters. Imagine a company you've known for ages, maybe for their classic fabrics, suddenly shedding that old skin, revealing something totally new, unexpected even. That's really the story of Raymond Ltd, a legacy brand, but it's going through this radical transformation. And that's what we're diving into today. Specifically, Raymond Ltd's unaudited financial results for the quarter ended June 30, 2025. That's Q1 of their fiscal year, FY26. We're pulling from their official investor presentation, board meeting outcomes, press releases, all fresh as of today, August 6th, 2025. So our mission here is to unpack the key numbers, really understand this dramatic restructuring, and explore how their new core businesses are doing, their performance, and their strategic outlook.
Okay, let's unpack this. What's the big picture here for Raymond's latest quarter, and what exactly are we diving into today?
Well, the initial financial snapshot for Q1 FY26, it really shows a company right in the middle of this big strategic shift. And the numbers, they reflect that. So Raymond reported overall revenue from operations at 524 crore. That's actually a pretty healthy 17% year-on-year increase from 450 crore last year, Q1 FY25.
Okay, 17% up. That sounds solid.
Yeah, and their total income also saw a good rise, up 11% year-on-year to 555 crore. Now, the thing is, while that top-line growth is strong, their consolidated EBITDA, earnings before interest, taxes, depreciation, and amortization.
Right, the key profit measure.
Exactly. That was 87 crore, which is actually down 8% year-on-year from 95 crore.
Right.
So this means the margin landed at 15.7%, down from 18.9% last year. And their PBT, profit before tax, for any exceptional items, that also saw a dip. It was down 31% year-on-year to 30 crore from 44 crore.
Okay, so that sounds like a bit of a mixed bag then. Strong revenue, which is good, but profitability taking a hit. Is that like a red flag, or does it tell a more nuanced story about this transformation you mentioned?
It's definitely the latter. And this is where understanding that strategic pivot is so crucial. The slightly lower EBITDA margin, it isn't really a sign of weakness in their new core operations. It's more a direct result of their strategic pruning, you could say.
Pruning? How so?
Well, by shedding the real estate segment, Raymond lost that other income that used to boost the consolidated figures. So this really signals a clear long-term focus on their core engineering businesses. And those just traditionally have different margin profiles. So, it's kind of a necessary short-term adjustment for that longer-term strategic gain.
Right, that makes sense. That's a critical distinction to make, because Raymond isn't the same company many of us knew, that sort of diversified textiles and real estate giant. They've gone through a really profound corporate re-engineering. First, their, iconic lifestyle business, textiles, apparel, garmenting that was fully demerged. Became effective June 30, 2024.
Right.
Then, the real estate business followed suit. Demerged effective May 1st, 2025 into Raymond Realty Ltd. And that actually listed its shares on the stock exchanges just recently, July 1st, 2025. So, the Raymond Ltd. We're discussing today is fundamentally different.
Exactly. This new Raymond Ltd. Is primarily driven by its engineering side now, its engineering prowess. And the restructuring of the engineering business itself was another major step. It got approved by the NCLT, that's India's National Company Law Tribunal, the body overseeing these things, on July 4, 2025. And it just became effective August 1st, 2025.
Okay, so very recent.
Very recent. And this move basically created two entirely new focused entities. First is JK Maney Precision Technology Ltd, or JKMPTL. That's now their core industrial manufacturing arm focusing on auto components. It combines the old JK Files and Engineering, Ring plus Aqua, and the auto business from Maney Precision Products.
Got it.
The second entity is JK Maney Global Aerospace Ltd, or JKMGAL. That's their dedicated high-tech aerospace and defense unit. And that was formed from the aero business of the old Maney Precision Products.
So if I'm hearing you right, we're essentially looking at a leaner Raymond. Much more focused, almost like a new company built around high-precision engineering. That's quite a bold strategic move.
It is.
Let's zoom in then on that aerospace and defense business, JKMGAL. How did this new segment actually perform in its first full quarter?
Yeah, its performance was certainly robust. For Q1 FY26, this segment, JKMGAL, reported revenue of 87 crore. That's a remarkable 37% increase from the Karawe 64 crore in Q1 FY25.
37%, wow.
Yeah, and their EBITDA also grew significantly, up 30% to 21 crore from 16 crore. The EBITDA margin was 23.7% in Q1 FY26. That's a slight dip from 25.1% last year, Q1 FY25, but the company attributes that mainly to a change in the product mix. FY26.
Okay, but still, a 37% revenue jump is really impressive. What's actually driving that kind of growth, especially in aerospace and defense in India? What's the bigger market picture here?
Well, the market opportunity is frankly enormous, and India is really well positioned to be a major player. Globally, aircraft sales are expected to hit something like $210 billion by 2027. That's growing at a 4.3% CAGR compound annual growth rate.
Steady growth.
Steady growth, yeah. And Asia Pacific is leading that charge. More specifically, the aircraft engine and other OEM markets, the companies making the planes and engines, they're projected to grow at 9% and 6% CAGR respectively over the next 5 years. The overall global aerospace components market is set to reach $132 billion, growing at a 10% CAGR.
Huge numbers.
Huge. And what's really interesting is India's role in all this. Indian component manufacturers are actually poised to capture about 3.0% of this global market share. And that's largely driven by two big things. The China Plus One strategy.
Right, diversifying supply chains away from just China.
Exactly. And the Indian government's Make in India for the World initiative.
So it's a massive addressable market, and India seems to be in a good spot within it. How does Raymond's newly focused A&D unit, JKMGAL, fit in? Their capabilities must be pretty specialized to even compete here.
Oh, they're not just competing. They are actually a leading exporter of highly critical aero engine components. They've developed over 1,200 different precision aero engine parts. That includes more than 350 parts just for the latest LAP engine variants. Those power a lot of the next-gen aircraft.
Impressive portfolio.
It is. They serve over 25 global aero components manufacturing clients, and they boast like a 2-decade relationship with top aero OEMs and Tier 1 suppliers.
So long-standing trust there.
Absolutely. And this expertise has made them a preferred supplier to the top 3 global aircraft engine manufacturers. They hold an astounding 88% market share in certain critical components for those manufacturers.
Wait, 88% market share with the top 3 global engine makers? That sounds almost monopolistic in those specific parts. What does that really mean for Raymond's pricing power? Or maybe their long-term competitive advantage in such a critical sector? And speaking of big names, I think their chairman and MD, Gautam Hari Singhania, announced some news recently with Pratt & Whitney and Safran.
You're right to focus on that 88%. It's not just a number. It indicates deep integration, a huge amount of trust, and a very, very high barrier for competitors to even try and enter. It suggests Raymond has highly specialized capabilities, probably intellectual property, and these long-standing relationships that are just incredibly difficult to replicate.
A strong moat, then.
A very strong moat. It definitely gives them significant pricing power and long-term security. And yes, those strategic long-term supply agreements they just signed with Pratt & Whitney and Safran aircraft engines for precision machined and assembled components. Those are huge validations. What's fascinating about those deals and the wider market is the long-term visibility it offers. The company notes there's a commercial aircraft backlog exceeding 16,000 units globally.
16,000 planes.
Yeah. That gives them essentially 12 to 15 years of visibility on orders.
That kind of foresight, 12 to 15 years, that's almost unheard of in many industries, allows for incredible long-term planning.
Exactly. And with over 70% of their aerospace revenue coming specifically from engine components, they are positioned right at the core of this very long-term growth cycle.
Their engineering prowess must be truly cutting edge to support this kind of business. What's special about their operational capabilities?
It really is. Their engineering is the cornerstone here. They have 20 state-of-the-art machines just dedicated to new product development, NPD, supported by 57 dedicated NPD engineers. They use a from-design-to-build approach, so they can take a concept right from the initial design phase all the way through to final production. And they operate 246 for really fast turnaround times.
246, wow.
Yeah. And a specific example of their capability, they manufacture complex engine parts like nozzle guide vanes for those Q1 1A engines. They have a dedicated facility just for that, aiming to produce 8,000 units per year.
High volume, high complexity.
Precisely. And their material handling is also quite impressive. They manage a diverse portfolio of 500 tons annually across 110 different varieties of raw materials. What's really striking is their significant use of specialized materials like Inconel. That accounts for nearly half, 44% of their consumption.
Inconel. That's a super alloy, right? For high temperature stuff.
Exactly. Crucial for advanced aerospace components that operate under extreme heat and stress. Using so much of it really indicates the high-value, high-tech nature of their production. Also, aluminum at 20%, titanium 19%, and steel alloys 17%.
Okay. Fascinating stuff in aerospace. Now, moving from the high-flying world, let's turn to their other engineering powerhouse, the Precision Technology and Auto Components business, JKM PPL. How did this segment fare in Q1 FY26?
Right. The Precision Technology and Auto Components segment, JKMPTL, it also delivered solid numbers. Their revenue for Q1 FY26 came in at 398 crore. That's a 12% increase from 355 crore in Q1 FY25.
Okay, decent growth there too.
Decent growth. Their EBITDA grew 8% to 42 crore from 39 crore. The EBITDA margin for this quarter was 10.6%. That's a slight dip from 11.0% in Q1 FY25, again attributed to a slight change in the product mix. It reflects the, dynamic nature of their pretty diverse product portfolio in this segment.
Okay, and to put that performance into context, what does the broader Indian engineering industry look like right now? How does this segment fit within that landscape?
Well, the Indian engineering industry is a colossal player, really, on the global stage. India exports over $20 billion worth of auto components every year.
$20 billion just in exports.
Just exports, yeah. And the OEM market within India is expected to grow at roughly 4.7% CAGR over the next 5 years. That growth is driven by major trends like the rapid adoption of electric vehicles, EVs.
Big one right now.
Huge. Also connected vehicle technologies, smart manufacturing, all playing a role. India's overall automotive industry is currently valued around $222 billion. It contributes about 7.1% to the national GDP, and it's projected to become the third largest globally by 2030. So yeah, this is a sector with significant tailwinds, both domestic and international.
Sounds like fertile ground for growth, absolutely. And you mentioned Raymond isn't just participating, they seem to be dominating in some key areas here. Can you tell us more about their market leadership within this JKM PTL segment?
Yeah, their market leadership is truly remarkable across several specific products. Take steel files, for example. They're number one in India with over 60% market share. But not just that, they're also number one in global installed capacity, with around 25% market share globally.
Global leader in files.
Global leader. Then, ring gears. They're number one in India. Around 55% market share in passenger vehicles and about 45% in commercial vehicles.
Dominant there, too.
Very. And for flex plates, they are the sole domestic manufacturer in India, holding about 25% market share. This kind of trust, it's been built over 7 decades as a Tier 1 supplier. They have over 100 large customers spread across more than 65 countries. And importantly, exports contribute over 50% to their total business in this segment.
Half their business is exports.
Yeah. So this isn't just about market share numbers. It's about being deeply integrated into global supply chains, being a critical, trusted partner worldwide.
So, okay, let me ask this. If I'm a smaller competitor trying to break into, say, the ring gears market in India, how tough does Raymond's position look right now? It sounds almost insurmountable.
It looks extremely challenging, I'd say. Raymond's leadership isn't just about selling volume. It's built on, decades of relationships, deep technical expertise, economies of scale. They've built a very, very strong competitive moat there.
Right. And beyond just defending these dominant positions, how are they expanding? Are they pushing into future growth areas within this auto components segment?
Oh, definitely. They are aggressively expanding into high-growth areas, particularly those driven by new automotive trends. They're developing high-precision components for clean powertrains, things that comply with the latest Euro 6 and BSI emission norms, boosting fuel efficiency.
Okay, meeting those stricter standards.
Exactly. They're also heavily involved in the EV and hybrid space, developing advanced, often complex precision components specifically for electric and hybrid vehicles. And beyond automotive, they're making specific complex parts for other sectors too. Think hydraulics, industrials, agriculture, locomotives, marine, even power tools. This business momentum is getting a strong push from that China Plus One strategy we talked about earlier.
Global companies looking for alternatives.
Right. And also from significant internal integration synergies they're getting from their own restructuring efforts.
Okay, so zooming out again to the overall picture for the new Raymond Ltd, how does this whole strategic pivot, this focus on engineering, reflect in their broader financial health?
Well, Raymond Ltd continues to show remarkable financial strength, actually. They remain a net debt-free company, which is quite significant. They actually boast a net cash surplus of 157 crore.
Net cash positive. That's healthy.
Very healthy. Their chairman and managing director, Gautam Harisinghania, he emphasized this. He stated they are, and I quote, well-positioned to capitalize on opportunities across both our subsidiaries, ensuring sustained value delivery to our stakeholders. So there's clear optimism internally about future growth, given their expansion strategy in these new product categories and also into new geographies.
Makes sense. Beyond the financials and the growth strategy, though, something else matters a lot today, especially to investors. A company's commitment to broader values. How is Raymond integrating sustainability into this new, focused engineering identity? Is there a strategic benefit there, too?
That's an excellent point, and yes, it seems very much integrated, not just an add-on. Raymond's commitment to sustainability is pretty evident, and it looks strategically smart, too. For instance, their focus on energy efficiency. Things like doing compressed air system audits to find and fix leaks, optimizing transport by grouping products and people better.
Practical cost savings, too.
Exactly. Installing sensors for auto lighting in offices. These directly translate into cost savings. Plus, their embrace of renewable energy is significant. Their main unit, for example, used 11.5 million units from solar power last year alone. That not only cuts their carbon footprint, but also makes them more resilient against energy price swings, and it boosts their brand reputation. And then there are things like oil recycling, implementing paperless factory systems using IoT, comprehensive waste management, including sewage treatment plants, metal scrap recycling, proper e-waste disposal. It really shows a holistic approach. It appeals to environmentally conscious investors, customers. It's about building a sustainable, future-proof business, not just a profitable one right now.
Okay, so we've taken quite the deep dive today into Raymond's remarkable strategic transformation. We've seen its pivot from that diverse, well-known conglomerate into a really focused engineering powerhouse. We've looked at its strong performance in the high-growth aerospace and defense sector, its market-dominating presence in precision technology and auto components, and all of this is underpinned by a healthy net cash surplus. So what does this all mean for you, our listener? You've seen how a legacy company, one maybe defined by its heritage products for decades, can undergo this radical, almost surgical transformation, shedding old skin to embrace new, high-growth industries. This isn't just, a corporate reshuffle. It's kind of a real-world blueprint for how traditional businesses can adapt. Adapt to new global demands, like diversifying supply chains or tapping into initiatives like Make in India.
And this really brings up an important question to think about. In this rapidly evolving global manufacturing landscape, how might Raymond's strategic demerger and this hyper-focused growth in specialized engineering sectors actually influence its future? Not just its financial performance, but its long-term competitive advantage and its positioning as a potential global leader moving forward.
Something to mull over as you continue your own explorations of these kinds of industry shifts. We'll catch you on the next deep dive.